I love receiving cash flow every single month, and in fact, in 2025, I'm projected to make well over $6,000 in dividend income, or over $500 on average every single month. The end goal of my portfolio is to one day be able to live off dividend income. Now, there are different methods for achieving this. For example, I love buying dividend growth stocks. These are companies that increase the amount they pay out in dividends every single year. A great example of this would be Broadcom, stock ticker AVGO. This is a company that was paying out 3 cents per share in dividends back in 2014, but if you look at their most recent dividend payment, it was 59 cents. That's nearly a 20x increase. And then we also have high yielding stocks. These are companies that pay out big dividends. An example of this would be Altria Group, who is currently yielding close to 7.7%. And then of course, there are companies who are somewhere in between these two categories. In this video, we'll be looking at the top 10 dividend stocks for 2025, and we'll be seeing a few stocks from each of these categories. Now, it's important to remember that over the short term, no one knows how these stocks will perform, but I can say these are stocks that I believe will help give you the ability to one day live off dividend income. Now, let's jump in. Stock number 1 on our list is going to be Lockheed Martin, stock ticker LMT, and this company is a solid combination of starting dividend yield sitting close to about 2.6% combined with dividend growth. Now, if we look at this company over the past year, they're only up about 5.97%, but that's because they've seen a pretty huge sell-off over the last few months. Look at this. In late October, the company was trading as high as $614 per share, and right now, it's trading at $483.37. Now, if we look at this company from a dividend perspective, let's jump over to my dividend breakdown sheet and come up here and plug in LMT. All this data will automatically load in. And like always, if you'd like to be able to download any of my spreadsheets you see in this video and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. And if you use code 2025, you can actually take advantage of the New Year's sale. That code is only available to the first 100 people, so check it out. There's a free trial if you're interested. But if you come down here, we can see starting dividend yield, like I said, sitting at 2.64%. So decent starting dividend yield, but we can also see a very solid history of growing those dividend payments over time. The 10-year dividend CAGR is 8.8 and the 5-year dividend CAGR is 7.2%. And here's what I love about this company. If we jump over to my stock screener and plug in LMT, if we look at revenue per share, we can see revenue coming into this business has been very stable, but also growing very predictably. And for the most part, the same is true with earnings per share and free cash flow per share. Now, why is this important? Well, as a dividend investor who loves buying dividend growth stocks, I want to note that the companies I own will be able to predictably grow their revenue and earnings over time, because that means they can grow their dividends over time. So my dividend payments continue to get larger and larger. And here's why I think this trend will continue for Lockheed Martin. If we look here, we can see in 2023, government customers accounted for 92.5% of Lockheed Martin's revenue, including 73% of the US government and 19.5% to international governments. So the vast majority of the revenue that this company is bringing in is coming in from government contracts. And I don't know if you've been paying attention, but the government is not afraid to spend your money. Lockheed Martin will continue to reap the benefits of these government contracts, continuing to grow their revenue per share. Along with this, the company has pretty impressive levels of return on invested capital, meaning that the projects they invest their capital into get very high returns. And if we look at this company from a valuation perspective, we'll jump over to our historical multiples valuation and zoom in a little bit, and here's what we can see. For the trailing 12 months, their price to earnings ratio is sitting at 17.2, while the average over the last 10 years is sitting at about 19.71. So compared to how the company has historically traded, they look like they're about 12 to 13% undervalued. And if we look at the company from a dividend discount model, this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. Assuming a 6% dividend growth rate and a discount rate of 8.5%, this company appears to be worth about $500 a share, meaning it's about 12% undervalued. The next stock on our list is going to be a real estate investment trust, and that is ADC, Agree Realty Corporation. And if we look at the stock over the past year, they're actually up about 10%, but in just the past month, they've started to see a bit of a sell-off down around 8%. Now, if we look at this company from a dividend perspective, we can see the starting dividend yield is now sitting at about 4.32%. So they pay out pretty big dividend payments, and something that attracts a lot of people to this company is they actually pay out dividends on a monthly basis, and they started doing that in 2021. So if we look at the past 3 years, Look at that steady and slowly growing monthly dividend. That's something a lot of people like to see. Now, when we talk about real estate investment trust, we have to remember a REIT is only as good as the tenants in its portfolio. And if we look at the top tenants in Agree Realty's portfolio, we can see some pretty popular names like Walmart, Tractor Supply Co., Dollar General, Best Buy, and CVS. Now, some of these companies have struggled a little bit when it comes to their financials over the past year, but let me be clear, they haven't struggled whatsoever paying rent. In fact, if we scroll down here on their investor presentation, we can see 69% of their portfolio is considered investment grade, which is pretty solid for a real estate investment trust. Now, if we jump over to my stock screener, there is one point I want to make about ADC. If we come down here, we can see ADC has been rapidly diluting their shareholders over the past decade. Now, we have to remember this is a REIT, so the situation is going to be a little bit different. REITs are required by law to pay out 90% of their earnings in the form of dividends, so really they have two ways they can grow. One, they can take on debt, or two, they can issue new shares to raise capital to buy new properties. And we can see ADC is elected to issue quite a bit of new shares. So a lot of investors don't like being diluted, but this is pretty typical when you look at a real estate investment trust. Now, from a valuation perspective, because we're looking at a REIT, we don't pay as much attention to things like price to earnings ratios. Instead, we want to pay more attention to price to AFFO ratios. So for example, if we look at the forward-looking P to AFFO, it's sitting at 17.09, while the sector median is sitting at about 15.44. So compared to some peers, it looks like they are about 10% overvalued, but we have to keep in mind this is a pretty popular REIT. A lot of people are willing to pay a premium for this company. Stock number 3 on our list is Canadian National Railway Company, stock ticker CNI. And this is another company with a decent starting dividend yield combined with pretty solid dividend growth. Now, I think the valuation on this one is very attractive. And look at this. In the past year, they're down almost 20%, and a year in the S&P 500 is up over 20%. So the company's trading a little above $100 per share. Now, if we look at this company from a dividend perspective, we'll come up here and plug in CNI. What we can see is a starting dividend yield sitting at 2.45%, and look at the 10-year dividend CAGR. It's very good, sitting at 10.62%. So that's double-digit dividend growth over a 10-year time period on average. Look at the history of increasing dividends, and we can also see a free cash flow payout ratio of 54.82. This means they're only using 54.8% of the company's free cash flow to pay out dividends, still leaving plenty of capital left over to do things like reinvest back into the business or even buy back shares. Now, when we talk about the company again, I can't help but think about the company's current valuation, and let me show you what I mean. If we go ahead and jump over to my valuation spreadsheet, I've already plugged in CNI. To start off, look at our discounted cash flow analysis. If we zoom in, the idea behind a discounted cash flow analysis is we can find the intrinsic value of the company by seeing how much free cash flow the company is projected to produce in the future. So in the scenario, assuming an 8% free cash flow growth rate, we can see the company comes to an intrinsic value of about $109.65, a little bit above the current trading price. If we look at the multiples valuation, what we're doing here is we're looking at how the company is currently trading compared to companies that are similar in structure. And we can see these similar companies, the average PE ratio is sitting at about 19. If we applied that same PE ratio to Canadian National Railway, we'd come to an intrinsic value of $172.60. And then finally, if we look at it from a historical multiples valuation, how has the company historically been valued compared to how it is now? We can see their trailing 12 months price to earnings ratio is sitting at 15.67, while the average over the last 10 years has been above 20. So it looks 21 to 22% undervalued compared to how the company has historically traded. And keep in mind, a company like Canadian National Railway has some clear competitive advantages. For example, they operate in an industry that has very high barriers to entry, and there's always constant demand. The rail transport remains a backbone of the North American economy. The one thing we do have to keep in mind is the potential for tariffs with the new administration coming in 2025. The fourth stock on our list is going to be one that I own in my personal portfolio, and that is Domino's Pizza. And if we look at them on Seeking Alpha, we can see the past year it's been pretty choppy. They're up about 2%, but if we look at just the past 6 months alone, they're down about 16.75%. Now, when we talk about Domino's Pizza, let's jump over to our dividend breakdown sheet and plug in DPZ. What we can see is this is the lowest yielding company that we've looked at so far, sitting at just 1.44%. But the starting dividend yield does not tell the whole story for Domino's Pizza. Let me show what I mean. Look at this. In 2013, this company's paying out about 80 cents per share in dividends, and by the end of 2023, it was $4.84, and as of 2024, $6.04. So this company has a 10-year dividend CAGR of close to 20%. So we're talking about astounding levels of dividend growth. But even that doesn't paint the full picture. For example, if we jump over to Bogle's valuation, what I want to focus on is going to be shareholder yield. And what this is dividend yield plus the buyback yield. When it comes to capital allocation, there's two direct options to directly reward shareholders, and that's paying out a dividend and buying back shares. And we can see Domino's Pizza does both of those things. So for example, we already see the starting dividend yield sitting at 1.44%. But look at how their weighted average shares outstanding has declined year after year. The average buyback yield over the last 5 years is close to 3.5%. So if we apply that buyback yield right here, we can see the shareholder yield for this company is currently sitting very close to 5%. So this is a very shareholder-friendly company. Now, what concerns a lot of people about Domino's Pizza is the valuation. Look at this, a forward price to earnings ratio of 25.73. They'd argue that's pretty expensive for a pizza stock, and I can see why many people would argue that. But here's what we have to understand. Look at the projected growth of the pizza market through 2033. Projections are telling us the market will grow at a compounded annual growth rate of about 6%. And if we look at earnings expectations for Domino's over the next few years, we can see it does fluctuate quite some bit, but I think we can expect to see maybe around 7% earnings growth. So if we jump back over to Bogle's valuation, assuming earnings grow at about 7% and a shareholder yield of about 5%, our expected return gets close to 12%. But we have to account for a potential decline in multiple, meaning perhaps investors aren't going to be willing to pay 25.7.3 price to earnings multiple for this company. Let's say over the next decade it drops drastically, maybe even 20%. If we jump back over to Bogle's valuation, that'd be about 2% a year. Because this company is able to still grow earnings and has a very high shareholder yield, you could still get an expected return of about 9.94% from this stock, even if the multiple over the next decade declines by about 20%. And to add on to this was actually a stock Warren Buffett added to his portfolio in the most recent quarter. We can see right here, this was a new addition to his portfolio. So as a shareholder of Domino's Pizza, I'm excited to continue to hold it in the future. Number 6 on our list is going to be our biggest dividend payer yet, and that is one of my favorite REITs, VICI Properties, stock ticker VICI. And this is a big dividend payer. In fact, if we go ahead and jump over to my dividend breakdown sheet and come up here and plug in VICI, we can see this company has a starting yield close to 6%. So we're talking about big dividend payments, and they also increase those dividend payments over time as well with a 5-year dividend CAGR of 7.7%. So this is a phenomenal combination of a high starting dividend yield along with pretty solid dividend growth. Now, when a lot of people talk about VICI Properties, they look at this. Over the past year, down 11%, and over the past 5 years, only up about 15%. So they start to get concerned about the potential growth. But this is where a lot of investors make the mistake of simply looking at how the share price is moving and not paying attention to the underlying fundamentals of a company. For example, if we look at things like revenue and adjusted funds from operation, it's growing every single year for this company. And in fact, look at this. Earlier this year, VICI Properties lifted their 2024 AFFO guidance, and this was an article released in early August. And just a few months later, they actually did it again, so the company's doing quite well financially speaking. And as a result, that's what allows them to increase their dividend payments over time. Now, if you aren't familiar with VICI, there's a few different reasons this is one of my favorite real estate investment trusts, and we can quickly see those reasons on their investors presentation. To start out, we can see 100% of their contracts with their tenants are triple net leases. What does that mean? Basically, what it means is that the tenant is responsible for things like property taxes, insurance, and building maintenance. And what it does is it allows the cash flows that VICI receives to be very predictable and very stable because they don't have to worry about these other variable expenses. So this is a huge plus in my book, but it gets even better. If we scroll down, one of the things we can see that they highlight is 2020 rent collection. Why would they talk about this? Well, a lot of REITs struggled to collect rent during 2020, but that wasn't the case for VICI Properties. They were able to collect 100% of their rent. That's a sign that they have quality tenants. Very important, obviously, if you're looking at buying a REIT. And if we keep scrolling down, something that's one of my favorite things about this REIT is their inflation protection that is baked into their contracts. So for example, right now we can see 40% of VICI's rent roll has CPI-linked escalation, and they're estimating that by 2035, it'll be up to 90%. So what this is telling us is if we buy VICI Properties, we actually don't have to be concerned about inflation because inflation is baked into their contracts. If inflation goes higher, then the rent that they collect also goes even higher. And so because of all these great qualities, we can see they've been able to increase their dividend payments at a much higher rate than the rest of their peers. So I'm a big fan of VICI Properties, and I'm actually excited that the stock is down about 11% over the past year. I think it creates opportunity, and also I'm going to be able to reinvest my dividends at even better prices, in turn giving me even more dividend payments in the future. So in fact, if we look at my dividend dashboard, we can see right now VICI Properties is projected to pay me about $473 over the next year in dividend payments. Stock number 6 is the Hershey Company, stock ticker HSY, and they have taken a beating over the past year. They're now down around 12%. Now, what's interesting about this is if we look at the starting dividend yield for this company, what we can see is it's currently sitting at about 3.25%. which is actually the highest starting dividend yield for this company in over a decade. And this comes as a combination as the company's increased its dividend payouts along with the huge sell-off over the past year. So the company now has a very nice combination of starting dividend yield combined with double-digit dividend growth over the past 10 years and over the past 5 years. And in fact, the past 5 years, they've increased their dividends at an even higher rate, close to about 13%. Now, what's been with the huge sell-off? What's going on with the company? Well, a huge factor that we have to understand is a major rise in cocoa prices over the past couple of years. Look at this. For the majority of the past 5 years, cocoa prices have remained relatively stable, but then 2023-2024 hit and they absolutely skyrocketed. And so if we jump over to my profitability sheet, let's come up here and plug in Hershey. At first glance, if we look at the gross profit ratios, it looks relatively stable. It doesn't look like too much is going on right here. We can see last year's gross profit ratio was about 44.7, which is pretty close to being in line with the 10-year average. But take a closer look. If we scroll down, again, we can see last year's gross profit ratio at 44.7. But using the ticker data function, if we go ahead and pull in Hershey's gross profit ratio for the most recent quarter, it's going to paint a different picture. What we can see is last quarter, the gross profit ratio was sitting at 41.26, which is considerably lower than last year's gross profit ratio. So again, those cocoa prices are starting to play a major role in the profitability of this company. Stock number 7 is going to be one of the largest dividend payers on this list, and that is going to be Altria Group, stock ticker MO. And they've had a phenomenal year, and over the past year, up over 30%, combined with the massive dividend payments that they're making. I felt like this stock was undervalued for quite some time, and it seems the market is finally understanding what the true intrinsic value of this company is. If we jump over to our dividend breakdown sheet, let's come up here and plug in MO. What we can see is the starting dividend yield for this company is sitting at about 7.68%. So again, large dividend payments, but they've also been increasing those dividends over the past decade, which is pretty impressive when you consider how big the dividend payments have been. The 5-year dividend CAGR is sitting at about 4% and the 10-year at 7%. Now, the huge concern most people have with Altria is that dividend payment sustainable? I mean, if we look at the payout ratios, we can see payout ratio according to earnings is sitting at 83.3 and the free cash flow payout ratio is sitting at 74.5. But if we look, since 2018, free cash flow has done a pretty good job of covering those dividend payments. We can see the free cash flow payout ratio has stayed in a healthy range. Now, that's typically higher than I like to see it, but if we actually look at what management has stated about Altria, Altria maintains its long-term objective of a dividend payout ratio target of approximately 80% of its adjusted diluted earnings per share. So what the management team is telling us is it's no accident that their payout ratio is close to about 80%. In fact, that's actually the goal for management. They understand that the best way to reward their shareholders in their case is to pay out those big dividend payments, and that's why so many people like this stock. Stock number 8 is one of the largest positions in my personal portfolio and one of my favorite stocks of all time, and that is Visa, stock ticker V. And if we look at the past year, it's been a good one. They're up about 21.8%, and in fact, if we look at the past decade, they've definitely outperformed the market, up about 385%. Now, people don't think of Visa as much as a dividend stock, but they should, and let me show you why. We can see, yes, the starting dividend yield is just 0.75%, but look at this 10-year dividend CAGR, sitting at 16.79%, and the 5-year sitting at 14.11%. So they're growing their dividend at a very high rate, but here's what's impressive about this. If we look at the free cash flow payout ratio over time, we can see it stayed in a very healthy range and has never climbed above 30%. So despite the fact they're rapidly increasing their dividend payments, their free cash flow payout ratio is staying low. And the reason behind that is because they're using the majority of their free cash flow to reinvest back into the business, in turn growing free cash flow every single year. So look at free cash flow versus dividends paid out down here. Free cash flow is easily covering those dividend payments. For example, in 2024, free cash flow $18.7 billion, while dividends paid out was only sitting at $4.2 billion. So again, they can do things like buy back shares, pay down debt, reinvest back into the business, and easily cover that dividend payment. And if we jump over to my stock screener, let's come up here and plug in V. What we can see is this company is predictably, reliably growing their revenue, growing their earnings, and at a very high rate as well. They're buying back shares, their debt to assets ratio is very healthy, and they have a very high return on invested capital. Again, meaning that the projects they invest their capital into get very high returns. And one of my favorite things about this company is just how profitable it is. In fact, if we jump over to my free cash flow analysis sheet, come up here and plug in V. What I really want to point out is the free cash flow margin. Now, what is free cash flow margin? What is this telling us? Well, Visa has a free cash flow margin of 52.03%. What this means is that for every $100 the company produces in revenue, $52.03 becomes free cash flow. Now, that's a very healthy free cash flow margin. Now, when we talk about stocks like Visa, people feel like they have a difficult time buying these stocks because it always feels like they're so expensive. For example, again, the company's up 21.8% in the past year, in the past 10 years, 385%. So what is the valuation like? Well, again, let's jump over to my valuation sheet and plug in V. And the first valuation that I want to look at is going to be our discounted cash flow analysis. So let's go ahead and zoom in. And we can see, assuming a free cash flow growth rate of 12.5%, we come to an intrinsic value of $321 per share, which is actually a little bit above that current trading price, meaning the company might be slightly undervalued, just barely. So how realistic is a growth rate of 12.5% when it comes to free cash flow? Well, to start off, if we look at how the company is projected to grow earnings over the next few years, we can see analysts are projecting double-digit earnings growth. That's a great sign, and it makes me believe that double-digit free cash flow growth, maybe around 12.5%, is attainable for this company. If we go ahead and look at them from a historical price to earnings ratio valuation, what we can see is for the trailing 12 months, their PE ratio sitting at about 31.57, and the average PE over the last 10 years is sitting at 31.46, so it's pretty much trading right in line with how it's traded over the past decade, meaning it's fairly valued. So it's pretty rare you're going to be able to buy a very high quality stock like Visa at a steep discount, but this is certainly a stock you could buy and hold forever. Our ninth stock is going to be one that's been growing in popularity quite a bit over the past year, and that's ASML Holding, stock ticker ASML. And over the past year, they're down about 3%, but look at just the past 6 months, now down 32.64%. And this comes when they had a pretty difficult earnings report. You can see right here in mid-October, the company missed on its bookings and also accidentally released their earnings report an entire day early. Now, if you aren't familiar with this company, they're a developer and manufacturer of advanced semiconductor equipment systems, and it's headquartered in the Netherlands. Now, the main reason people are so bullish on this company is because they essentially have a monopoly on EUV technology, which is going to be a crucial player in high-growth industries like AI and cloud computing. And to reinforce this competitive advantage, they're actually ramping up their research and development. So for example, let's jump over and look at the quarterly data and look at research and development expenses for this company. You can see it's growing nearly every single quarter. And again, this is simply going to reinforce their competitive advantages. And it's hard to understate how fast this company is projected to grow their earnings over the next decade. Look at the earnings estimates from analysts. Yes, they are having a rough year, but after that, for the next few years, they're projecting above 20% earnings growth and double-digit earnings growth beyond that. And along with this, the management team has stated that they are planning on growing their dividend on an annual basis. What we can see is as of right now, the starting dividend yield is sitting at about 1%, but look at that 10-year dividend CAGR, 23.2%, and the 5-year sitting at 13.6%. So yes, this is a high growth company, but you can expect the dividend to grow along with it. Now, I will say the free cash flows from this company are expected to be pretty choppy moving forward year over year. So if you buy this one, be willing to hold and handle the volatility long term. And then stock number 10 is a company that I added to my portfolio over the last year, and that is Louis Vuitton, stock ticker LVMHF. And this company has had a difficult past year. It's currently down about 17.11%. And they've had a lot of trouble with growing revenues in the China market as of the past year. But here's what's really, really exciting about this company. Look at the insider buying over the past year. insiders have been absolutely loading up on the stock, and most notably, the founder of this company, Bernard Arnault, has been buying most of these shares. And it's estimated that he now owns over 50% of the entire company. So this is definitely a bullish sign for the company, something that makes me very excited to be a shareholder. Now, if we start digging into them a little bit deeper, let's go ahead and look at them from a dividend perspective. What we can see is a medium yield, but high levels of dividend growth. The past 5 years, dividend CAGR has been close to about 15%. So again, that is rapid dividend growth, and it's been backed by growing free cash flow as well. Now, one thing I do want to point out about this company, if we jump over to my profitability sheet, again, we'll plug in Louis Vuitton. What we can see is, yes, double-digit revenue CAGR and double-digit net income CAGR, but perhaps even more impressive is how high their gross profit ratio is and how stable it's been over the past decade. Typically for retailers, we're going to see much lower margins, but this is a luxury company and they have luxury margins. And if we look at the 10-year average gross profit ratio, it's sitting about 66.23, and in fact last year it was even higher, sitting at about 68.8. Now, there are certainly headwinds ahead for this company, especially in the Chinese market, but from a long-term perspective, I like what I see in this company, and the insiders at Louis Vuitton seem to agree with me. So there you go, those are the top dividend stocks for 2025. But before you go, I want to give you one more bonus stock. And it's only fair that I mention it because it's the largest position in my personal portfolio, and that's going to be the Schwab US Dividend Equity ETF. The fund has a phenomenal combination of a pretty nice starting dividend yield, currently sitting at about 3.62%. It sees double-digit dividend growth, and it sees pretty solid share price appreciation over the long term. There's a reason that I feel comfortable making this the largest position in my personal portfolio. Again, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description and get a 7-day free trial. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.